the markets are feeling a bit brave right now. We have some interesting things going on as far as risk premiums. We talked a little bit last week about how you're using options to play your bearish view, but minimizing some of that downside risk. Well, the cost to take similar positions is at the lowest level in 2 decades. And the cost for buying protection against a 5% dip in equity markets is fallen to what some have claimed to be the cheapest you'll ever see. So what are your thoughts on what feels like maybe extreme risk taking? Is that what you might consider it?
Yeah, and I'm the first to hold up my hand and say that I've been wrong. I haven't been overly bearish all year, but I've been tilted bearish all year. Luckily I didn't kind of get quote unquote net short until about a month ago. And then luckily, when I did get net short, I did it via options rather than just being outright net short. And so while the decay on those options has hurt me a little bit, it hasn't, wiped me out, and it hasn't caused this huge drawdown. But I'm the first to say that I'm feeling a little bit of FOMO. And I say that so for anybody watching, the part of the reason I say that, it's not because professionals don't feel the same things that you feel. But I think part of being a professional, at least sometimes, is being able to withstand those feelings. And I think that's a big part of this business. But the reason that FOMO is real, and the reason that FOMO is something that you have to consider, and the reason that the markets could go higher, despite all of these reasons that I will tell you why I think they're due to pull back, is because there's probably a lot of people that are feeling it even worse than me. Their jobs may legitimately be on the line if they continue to trail their benchmarks. And if the market continues higher, they may be quote unquote forced into either covering shorts, and you get a short squeeze, although there's not much chance of a short squeeze anymore because of positioning. But you could still have money on the sidelines come in and push it higher for the people that have been overly bearish. Now, having said all that, I think it's very possible that the markets continue higher, kind of into August, but I don't think it's worth chasing here. And the reason is for these things that you alluded to. At the beginning of this year, and I know we talked about this over the last couple of weeks, but it's just getting more and more pronounced. At the beginning of the year, the put-call ratio was at its highest level, I think, ever, or at least in the last 10 years or something. And we used that as justification for why the markets might rally in the early part of the year. That is completely reversed. Now the put-call ratio is as low as it's been in a very long time period. The VIX hit its lowest weekly close since January of 2020. Now, think about what happened in February and March of 2020, right? So the last time we were at these levels on a weekly level in the VIX, it didn't stay there very long. And that's the thing with something like the VIX. It can, when it moves, it can move very quickly. You come out to the equity risk premium that you were talking about, the gap between the NASDAQ and the 10-year. A number for people who follow DMARC indicators, which is it's basically a counting system which uses a mathematical formula to tell when things are reaching their peak, trends are reaching their peak, or the downtrends are reaching their bottom. Those hit a sell 13 signal this last week. So any one of these individual indicators on its own probably doesn't mean a whole lot. But when you get a number of them over and over and over, and they start adding up, you get 5, 6, 7, 8 of them all together, that to me is the time to say, despite the FOMO you may be feeling, that is the time to be careful, because I know it's going to happen. All these people who've been sitting on the sideline and who are feeling FOMO, when they finally give up and they finally go in, everything's going to roll over and they're going to get hurt the other way as well. So those are the kind of things I'm looking at right now. I'm the first to admit that, my bearish bias has been wrong this year. I'm the first to admit that could continue to be wrong for a little bit longer, but I'm also kind of steadfast in my belief that we're not going to have a second half of the year that is as smooth sailing as the first half of the year was.
Okay, so one of the things that visually I think is impactful is that NASDAQ versus 10-year chart. You have this really wide alligator jaws. And if NASDAQ represents that momentum risk-taking attitude, And the 10-year, who knows what it's representing now? It's definitely representing the market sentiment that inflation isn't going anywhere. But to me, in terms of kind of this idea that a rally might be getting exhausted, where some of this movement in equities and the risk assets has felt earlier on, at least the narrative was that this was driven by somewhat of a front running, because eventually the Federal Reserve is going to break something. They always do during rate hiking cycles. They're going to cut rates, and then off to the races, all these asset prices go. Well, if we've already kind of potentially exhausted that momentum, and if charts can tell us anything about the future, eventually, you're going to see this open mouth alligator jaws collapse a little bit. And so I'm wondering what ultimately is the trigger there. And is this kind of the point that you're talking about, that some of this momentum is just exhausted? And on that point, you have Bitcoin that's up 75% year to date. Earlier in the year, we did a few episodes where you talked about, this was more leaning into the end of Q1, where you talked about, hey, where managers could potentially push this market up because they have to rebalance. They're chasing the benchmark. They're getting pressure from whether it's clients or just, outsized performance with indexes overall. Is this somewhat a picking up a nickel in front of a bulldozer moment? Or is there something else here that you think is the market's trying to tell us when we look at, charts like that?
Well, I don't think it's any one thing, but here's where I think it's interesting with regards to those things that you talked about. Number one is people need to realize that markets don't move on the news. Markets move on the anticipation of the news. And that's where the saying, buy the rumor, sell the news comes from. Oftentimes, if you look back at many Fed hiking cycles and then Fed cutting cycles, they typically hike. The economy slows, it rolls over into a recession, and then they start to cut. Typically, it's when they start to cut that that equities start to sell off, right? And the reason they're cutting is because equities are selling off. And when that happens, equities typically do not turn around and start rising immediately just because they do one cut. They often have to do more than one, including some other moves, in order to arrest this now descending trend. So that's the first thing I would say. The other thing I would say is it's kind of ironic to me in that last year, it's not ironic, but it will sort of prove the point that I'm talking about, but it's also ironic in that, so last year, the NASDAQ sold off very hard on the anticipation of coming rate hikes, because NASDAQ growth stocks, high growth stocks, tend to have an embedded interest rate play in them, because when rates are really low and growth is out there, then growth does very well, and when interest rates are rising, then growth typically does poorly. So last year, the NASDAQ sold off very hard in anticipation of rates rising, which in the latter of the half of the year, and even this year, they did. But now, with equities, or with the anticipation of interest rates coming, or interest rate cuts potentially coming, it continues to rise because it thinks it's going to be more liquidity. But the reality is if it doesn't roll over, then the Fed is not going to cut, right? And so you just keep going up and up and up and up, and then to your point, you'll eventually hit that momentum, the end of that momentum, and if for no other reason that it's just exhausted, it falls. So I think that's pretty interesting. So because if part of the reason, so the NASDAQ is rising in anticipation of a cut coming, but the reason the cuts would come is because growth slows. And if growth slows, then NASDAQ, which has gone farther than all the others, is likely to pull back the most, in my opinion. So I think that's pretty interesting. Also, I think with regards to the Fed having to cut and go back to either a pause or a cutting, and even going back to QE, what that would do for fixed income. I think it's a little bit of what people kind of want to see, whether they're actually going to do it. And the thing, going back to, for them to cut, it would mean that there's something wrong in the economy. There's a hole out there that they are now trying to fill. And unless they immediately go back to a stimulative effort that we know is big enough to fill the hole, that first move is typically not enough to fill the hole. If I hope that's making sense, because, for the Fed to go back to an easy monetary policy or even doing QE, there's got to be a lack of liquidity out there. There's not a lack of liquidity right now, and that's why equities continue to move higher. So for them to all of a sudden move to filling a hole, it must be that there's something out there that we don't see or that the market doesn't understand. And as a result, it's unlikely that the first move the Fed would do would be enough to fill that hole. And that kind of goes back to what I was saying earlier. A lot of times when the first cut happens, equities continue to sell off because oftentimes that first move is not enough to counteract the now deflationary forces as opposed to the inflationary forces.
This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.